All right, so let's give this one more shot. Um, so I'm going to start back from this beginning kind of sales pitch piece because I think this is really important, and I think laying the groundwork here and doing a good job of it is going to really help us get off on the right foot for the course. So, what are we doing here? Big picture objectives. Now, as I talked about on Tuesday, this is the kind of MBA program's suggested learning objectives for the course. And so their suggestion is essentially to help us get this toolbox of modern financial theory. And as you guys may have realized as of Tuesday, that's going to look a lot like calculations. And so a big chunk of this course is going to be learning the various methods that are used to value debt securities, equity securities, potential projects, all sorts of stuff. And so we'll, as we kind of progress through the course, find the, idiosyncratic issues with each type of asset class. And we'll worry about those as we get there. But in order to do that, we need to start developing some tools. And so once we've developed that set of tools, the second bullet here says that we'll develop the ability to analyze financial decisions. And so that's a really broad statement, obviously, but financial decisions here mean just about anything. And I made this point indecorously in class on Tuesday, but effectively, this is a big statement, right? This is making any financial decision that's out there. And even from an accounting professor perspective, I think that finance, and especially introductory corporate finance, is probably the most important skill set that any business person can have. And I realize that's a big statement. Don't get me wrong. I'm, hanging quite a bit on the subject matter of this course, but hopefully the fact that I'm re-recording the first day's lecture is a good indication in just how important I find this material to be. And so I think it's important that even from first principles, that this is done well and that someone is giving you guys a high quality education on something that's going to be very valuable for you. And then, so by the end of this course, the MBA program has a couple of objectives. And these are written in the form of things you can do. But as we talked about, there's also this kind of goal of preparing you for future finance electives. So first one here, analyze a firm's financial statements from a finance perspective. So kind of unraveling some of that accrual accounting stuff that we talk about in intro financial, and instead looking at those financial statements from a finance perspective, which is typically more cash-based. It also has the kind of viewpoint of whether additional funds are needed. So for example, if you have a potential project that you'd like to engage in, but your current base of assets or working capital, which we'll talk more about as we get later in the course, if those are insufficient to fund the project that you're interested in doing, well, then of course you've got this issue where you'll need to acquire new financing. And you can do this either by issuing debt, so taking out a loan, or raising equity by soliciting new investors, or you could potentially use your own cash if you have retained earnings, if you have money within the firm. But to the extent that those retained earnings aren't sufficient, then you can go out to the capital markets and you can have them provide the extra funding. Now, there's definitely an argument to be made, and we'll talk more about it when we get to the investment project component of the course, but there's an argument to be made for keeping a certain amount of cash on hand. So for example, if you have $100 million in the bank, but the potential project you'd like to undertake is, say, 90 million. Well, you didn't just stumble upon that 100 million that you have, right? There are good reasons that you're holding it, whether it's some sort of cushion for your potential future, say, inventory needs. You might need that cash to purchase more goods that you can use to sell. Whatever it is, let's say debt service or something like that, that you need this 100 million for. Using 90 million of it towards a potential new project leaves you in a pretty precarious position. It leaves you with only 10 million in the bank, whereas just yesterday, you would have kept 100 million, given kind of the obvious choice that you made of having that amount in the bank prior to the investment deal. So we'll talk a little bit more about cash management and kind of the risk of using your own retained earnings on a potential project as we get a little farther in the course. Second here, evaluate projects and make investment decisions based on data. And so again, we're going to use this valuation approach that we develop on a number of different things, whether it's valuing particular asset classes or whether it's evaluating a particular project the firm might be interested in undertaking, regardless of how we look at the various kind of options available to us, we're going to apply a very similar methodology. And then C and D here are very similar to that, understanding how these corporate decisions impact firm value. Part of that is that evaluating projects piece from the previous bullet. And then D here is saying essentially understanding how to value various assets. E finally is a slightly different take on the same problem where we're going to calculate risk-adjusted rates of return. Effectively, we're going to analyze the risk in a potential project or in a potential investment. And the risk of that investment will help us determine the rate of return that we should demand from that project. So as we talked about a little bit, if you have a potential project that say has a 1% chance of success, a very, very low chance of success, 99% chance you completely lose your investment, 1% chance it pays off fabulously, say a potential new pharmaceutical drug where the risk of that particular project is quite high, but the potential payoff is also quite high. That's going to be a very risky project, and so the expected return, the amount that you're going to demand from that potential project is going to be very high to compensate you for the 99% chance that you get nothing. And then finally, we'll talk a little bit about portfolio diversification, which we talked a little bit about last time, but it's basically the idea of investing in various industries so that the risk of those various industries or those various companies nets out. So in a world where certain companies are doing well and other companies are doing poorly, we would like to be invested in both of those classes, because in another state of the world, say a recession versus an economic boom, it's possible those effects reverse. It's possible that Goldman Sachs does really well when the economy is doing well and really poorly when the economy is doing poorly. By contrast, I use the example of healthcare stocks. They're what are known as contracyclical or countercyclical. Essentially, it means they operate opposite to the typical sort of economic trends that we see in the market. So when there's a recession, healthcare stocks tend to do really well because people invest in their health. They aren't able to lose their jobs, they can't afford to. And so they'll try to make sure they stay healthy so that they don't get sick and have to take time off. Now, if I have both Goldman Sachs and some healthcare stock in my portfolio, then when the world's really good, healthcare stock might underperform a little, but Goldman stock goes up. On average, I have some, return, let's say 5 or 6%. Yes, there's a negative effect. Yes, there's a positive effect, but on net, hopefully it's still positive. And then when the recession hits or whenever some economic downturn comes out, then all of a sudden my healthcare stock outperforms and my Goldman stock goes down. Again, the hope is that after those kind of risk effects of each individual stock nets out, that the average return for the portfolio is still positive and enough to kind of generate whatever return you'd hope for. So we'll talk a lot about portfolio theory and how diversification works, but that's the basic idea. It's essentially just making sure that you're widely invested so that any idiosyncratic risk, any risk of an individual firm or an individual industry is netted out based on all of the other industries that you could be invested in as well. Okay, so we talked about this idea that the course is called financial management. And so financial management, as I said, it doesn't really have a solid definition. There's no one thing I can say is financial management. Instead, I tend to think of it pretty big picture, and I try to do it more through an almost an inductive reasoning sort of approach. Instead of saying something broad like making decisions on behalf of the firm's investors, which is a very broad statement. Instead, I like to think of the various decisions that might be made by a financial manager and allow you guys to kind of write your own definitions for it. And so the examples that we have here, we might launch a new product. And if we launch a new product, we need to evaluate whether that product will ultimately add to firm value or not. We might make a new product to buy or resell, or rather, we might make a product to buy or buy it and resell it. So we may make the individual product, or we might just act as a retailer. So if we manufacture the product from scratch, that has a lot of cost baked into it, but it also increases our potential profit because we can sell it at retail prices instead of wholesale prices. If we instead just buy it and resell it, that adds a certain degree of risk to the extent that our manufacturers can't keep up with, say, supply contracts. You see that a lot right now with chip shortages and all these other sort of supply chain issues that people are having. So there's a difference in the amount of risk that's baked into these, as well as the potential cash flows that would come out of them. Rent or purchase new property. Well, the idea here that you might have some sort of equity is a potential value, right? It's the potential that we could own this asset and we could get a benefit from it, maybe incremental to the value that we would achieve from just renting the property. If we rent the property, it's possible we'll pay our rent every month for however long is necessary, and that's it. When we vacate the premises, there's no additional value. By contrast, even if purchasing the property maybe costs a little bit more, it's also possible that we'll have some disposal value at the end of our use for that property. So you can imagine renting an apartment while you're in college versus buying a house. If you buy a house, it's possible that the value of that property will appreciate. If it appreciates, then it may actually erase most of the cost of occupying that property for whatever period of time you're there. When you go to sell it, it might recompensate some of the mortgage payments that you made in the interim. Now, by contrast, if you just rent an apartment, you'll pay out that cash, and when you leave, there's no salvage value, there's no kind of final payout, there's no need to sell the property. So the cash flow structure will certainly be different, but the degree to which there's risk is also different. Because you can imagine buying a house in 2006, and your college education lasts, say it's a 2-year MBA program, lasts until mid-2008. Well, there's a significant degree of risk there, right? Housing prices were pretty far down as of 2008. And at that point, you could imagine that that would create an additional negative cash flow. When you sell the property, there's actually a gap between the amount you continue to owe on that property, the mortgage, and the value that you're able to get for the property. So there's an extra degree of risk that's going to go into the purchasing piece, but the actual cash flow for the life of the project may be higher if you're just going to rent. And so these are the sort of considerations that they might undertake as a financial manager. And then finally here, finance a new project through debt or equity. That we'll talk about a little bit later when we think about capital budgeting. But there are all sorts of considerations that somebody might undertake when they're trying to decide whether they should finance a firm by borrowing money or seeking out investors. And so if we kind of take these big picture decisions and we distill them down to just a couple of basic tasks, we've got about 2. One is the day-to-day operations of the firm's capital, and then the long-term financing decision of the firm. So day-to-day operations are things like, should I purchase more inventory today, or should I do this on consignment? Should there be some additional sort of arrangement that I arrange with my suppliers? Long-term financing decisions are more big picture. Does it make sense for the industry that we're in to borrow money? There are some industries where cash flow is so volatile that they can't be sure that they'll have the money to pay the debt. You can imagine it like a car loan or a mortgage where that debt comes due every month. There's some payment that's expected from the lender on a regular basis. And to the extent that you can't guarantee there to be cash flow, you may default on the loan and go bankrupt. By contrast, that debt tends to be a much cheaper form of financing relative to equity, for the very reason I just mentioned, which is that the cash flow that's guaranteed by the bond agreement or by the loan agreement creates a certain stability. There's less risk and there's less of kind of this, will they pay me, will they not? And you'll know much sooner whether the firm has defaulted, whether the borrower has defaulted on the loan, because if they miss one monthly payment, something's gone wrong. So all of a sudden, there's this additional factor to consider, the risk that's going to be baked into these cash flows, as well as the actual value of the cash flow themselves. On the other side, we can think about equity holders. We can think about investors into a firm. Investors in a firm are guaranteed zero cash flow. There's no guarantee whatsoever that a firm will ever pay out a single dollar of dividends. Instead, shareholders are investing in a firm with the idea that at some point in the future, their investment will be worth more than it is today. That doesn't necessarily mean that the firm needs to have cash on hand available to pay out money to the shareholders. It simply means that they need to generate positive value projects, that the firm needs to undertake creating new products or creating new services that will generate more profitability than they do cost. So more revenue needs to be generated than expenses. And to the extent that they can do that, and they can do it large enough to compensate for the risk of investing this money today, then the shareholder's happy. Now, of course, some shareholders invest in stocks that pay dividends for very good reasons, but big picture, kind of financing decision-wise, the risk that equity holders are taking on by investing in a company that doesn't guarantee cash flow has to be compensated for. There is an additional degree of risk there because if the company goes bankrupt and they don't have enough money to pay their debts, the equity holders get nothing. The firm could be completely worthless. It's unlikely that debt holders will get exactly zero. They'll get something from the liquidation during bankruptcy or some sort of renegotiation of the debt. Equity holders, by comparison, can be left, holding the proverbial bag, so to speak. They can have a complete zero value investment. It could become completely worthless. And this risk that it can become completely worthless has to be compensated for. As a result, the cost of equity tends to be higher than the cost of debt. And so when a firm's determining, well, we've got this volatile industry, we can't really afford on a cash flow basis to invest in debt, or rather to borrow using debt, we have to go into the equity markets, we have to tap investors that way, but there is an extra degree of cost. There is a higher hurdle to clear for the firm's profitability to satisfy that equity investor, because that equity investor has a higher risk sensitivity. Okay, so this is the big picture sort of overview of this field. And so we've got firms on one side, we've got investors on the other. And so from an investor perspective, they'll ask questions like, how much should I pay today for future cash flows? So for a bond holder, for a debt holder, for example, you can imagine a bank. A bank is going to say, how much money can I get from this company in the future in the form of future cash flows in exchange for my investment today? In other words, if I expect that this company is going to pay, say, $600 every month for the next 20 years on this potential loan, given my risk assessment of how risky I think it is that they'll be able to satisfy those payments, how much should I be willing to loan them today? Now, it might seem a little strange to think of it in those terms, but if you imagine that a company comes to you, brand new startup company, I say, I'm going to start this new app, right? There's this kind of high-tech startup idea that I have, and I have no idea what my cash flow will look like. In fact, I don't even really know how much money I need because all of my estimates of my expenses are fairly loose. They're all kind of just best guesses. And so I go to a bank and I say, will you loan me the money to start this business? And they say, okay, come up with your best guess of what your next 2 or 3 years of cash flow will look like. You do that. They do a due diligence exercise on that information and they make sure that it's at least reasonable, that that's the cash flow that you could earn. And using that cash flow stream, using that expected future profitability, they can determine how much they think your business is worth and how much they think they can reasonably loan you that they'll be able to get back. Now, that leaves kind of completely unstated the interest rate. The interest rate will also determine the riskiness, or rather the riskiness will determine the interest rate. They'll determine how risky they think this high-tech startup idea is, and they'll set an interest rate commensurate with that risk. And as we'll show in a little bit, and as we talked about on Tuesday, the higher the interest rate, the higher this assessment of risk, the less I'm willing to pay today for a risky future cash flow. So if I think there's no chance whatsoever that you're profitable, I'm going to pay virtually nothing for those future cash flows because the chance that they ever manifest is going to be pretty much zero. By contrast, if you tell me you're going to do something incredibly profitable and that's fairly stable, then there's this extra degree of certainty I have about those future cash flows. And so my assessment of that likelihood of default, that likelihood that you go bankrupt and never pay me, goes down. And so I should be willing to pay slightly more for those future cash flows, given that they're more certain. So that's how investors are going to think about these things. Equity investors will think the same way. They'll just worry also, in addition to the cash flow piece from dividends, they'll also worry themselves about capital gains, the projects that the firms might undertake, and then the kind of return on their invested capital, the return on their money that they put into the firm that those projects are able to generate. On firm sides, they also have investment decisions. They aren't dealing just with external investors. They aren't just doing this equity capital or debt capital arrangement. They also need to invest money. But here, instead of investing money in other companies, instead of investing money in other firms, although that does happen, they invest money in projects. They invest money in various investment decisions that look like the goods and services that we all consume. You can imagine that a grocery store, for example, is determining whether to stock a new product, one versus another, and that real investment decision involves buying that inventory from that supplier and putting it on the shelf. Whether they should do that or not is ultimately going to be a function of their assessment of the potential future sales of that product. If they think this is too niche, this is too, say some nut-free granola bar. Nowadays, there are these rules in various elementary schools around the country that you can't send your kid to school with snacks that have nut products in them, right? Due to all the kind of nut allergies and the sensitivities for those things. If you were instead to be in 2000 and you were to ask a grocery store buyer, would you like to buy my nut-free granola bars? They might not see the market for it. They might not see that those things would actually move if they put them on the shelf. And so instead they might pass on the investment because they don't see the future cash flow potential. So those investments, these what we call real investments, and it's in quotation marks because all investments are real, right? It's all happening in the physical world. But a real investment here refers to an operational decision as opposed to a purely financial one. Now, real investments, whereas say debt capital, that is the money that a debt investor might give to a firm, will pay back interest and principal. So the firm will pay the debt holder, the bond holder, the lender. They will pay in exchange for that debt money. They'll pay back interest and repayment of the original principal. An equity holder will invest equity capital and in exchange will get dividends and potential share repurchases. We'll talk more about repurchases later. So this is the exchange with an external investor. But internally, they will invest money into a potential project and the outflow, what they expect the investment to return to them, will come in the form of operating cash flows. Okay, so I'm doing this on my iPad so that I can actually write on this thing. So whenever we do some of the time value of money problems, I can sketch it out for you here. But so this is that's why I'm saying that, because this E is kind of hanging here. This box I can't rearrange in the moment. So here what I'm trying to show is that finance is kind of central to a lot of the various decisions that a firm might make. And so you can imagine that, as we talked about with a grocery store, when they're considering whether a potential product will sell, they're relying on the marketing expertise within the store or within the brand that they're speaking to determine what they think the demand for a particular product is. That demand information is then funneled back into, and you can see these are double-headed arrows, is funneled back into the finance department so they can make better decisions. The strategy group might concern themselves with potentially placing the products in a certain way. Maybe we are, trying to create a sort of health-conscious image. And so nut-free granola bars or products that aren't sweetened with sugar, but instead are sweetened with dates. Things like that might be the industry we're interested in entering into. And so that's information that the finance group needs to know, because even if marketing assesses that market is especially small right now, at some point in the future, if we really penetrate that market and really develop it through a marketing campaign, then the expected future cash flows, not just next year or the year after, 10 years down the line, the finance group needs to know that the risk of this project is fairly small, even though the expected future cash flows for the next year or two may be small as well. Operations, that one's pretty straightforward. This idea that day-to-day sort of operating activities need finance input. And then information technology, this is more about the information that's going to flow into the finance department from all three of the other sort of categories we've talked about. So again, if we think about kind of how finance fits into this, finance is going to help answer a couple of different questions. One, how do I get capital to implement my strategy and my operational ideas? And also, how do I best commit the resources of my firm? The capital that I've acquired from equity markets or debt markets, the internal capital that I've raised through selling my products or selling my services. How do I take those resources and put them to their highest and best use? Well, the way we typically do these things, and there's a very complicated decision that goes behind them, but the way we typically do it is that we invest into risky projects. It's not feasible to say we're just going to sit on money because inflation's a real thing, as we've become painfully aware of in the last couple of years. But essentially, if we just hold on to the money, it loses value. It loses value against inflation to the extent that a dollar today is not worth as much. If we wait and spend it in a year from now, we would much rather use that dollar today than use that dollar tomorrow. But also there's the foregone opportunities. We could have invested in a project that would return on average, say 10%. And if we don't invest that money, if we hold on to that money instead, we've now lost the value in real terms from inflation, but we've also lost that potential 10% profit. So what we are going to do in committing these resources is we're going to exchange these resources today, capital today, that's what we mean when we say resources in a finance term, for an uncertain future benefit. And uncertainty is not inherently bad. If we have a broad enough portfolio of risky investments, they won't all go wrong. I mean, they could, but the chances of that are small. Instead, what we try to do is diversify the various projects that we invest into, where ideally, when one goes poorly, the other goes well. You can imagine that in a grocery store context, I like grocery stores because they're tangible, right? You can think of how these decisions are made. You can see how consumers interact with the shelf. It's just something that's very easy for a lot of people to kind of grapple onto. So I think of a grocery store in this context because you can imagine them stocking 50 different cereals. They've got the weird ones that's got like the almonds instead of any, flakes or sugar or anything. And then they've got the ones that are essentially just sugar nuggets in a box. So there's like Frosted Flakes, or they have ones now that are like Hostess Twinkie cereal, which just seems insulting. And then they've got the ones that are super healthy and great for you, right? Well, to the extent that society kind of in big picture is moving away from the sugar chunks and they're moving more towards the healthy granola stuff, there's risk in stocking those sugary ones. But they manage to diversify away that risk that society becomes more health conscious by also stocking some of those healthy products. Both of those are uncertain future benefits. Stocking those products, we have no idea what's going to sell. I mean, marketing will try to tell us and we'll try to come up with a best guess, but we don't know for sure. It could be that tomorrow news comes out that these healthy cereals are actually poisonous. And so as a result, everyone flees away from those and goes back to the sugary ones. It could be that news comes out tomorrow that high fructose corn syrup causes cancer, and so then we'll shift away from those. That uncertain future benefit tells us that there's a potential return to be had. The fact that we don't know for sure what tomorrow looks like allows us to kind of compensate for that future uncertainty by demanding a higher rate of return. In a grocery store context, that looks like the grocery store negotiating cheaper prices with an untested product. These healthy cereals that maybe have no track record of sales aren't going to be purchased at the same price. The retailer, the grocery store, will demand a cheaper wholesale price from that brand due to that uncertainty. And if we have the appetite for that risk as our grocery store, or if we have benefits from diversification due to this, then we'd be happy to engage with that product. So these are the sort of decisions we can imagine a financial manager making. And so this was me saying, I think I'm going to strip away all the MBA language that the program has put together in terms of what the course objectives are, and I'll tell you my two. First, as a corporate manager, how do I make investment decisions? All the sort of stuff we've just talked about. And second, I need to provide you the foundation, all of the quantitative tools that are going to allow you to succeed in some of these finance electives that come after. So I made a quick pitch here, and I'll do it again now, that kind of society's pushed away a little bit, even at the CFO level, at the C-suite, kind of top of big public company levels. Society has pushed slightly away from this notion that shareholders are the only ones that should benefit from company activities. So you can imagine that a big oil company, not that most big oil companies are mustache twirling villains, but they're kind of the ones that are vilified in the public dialogue around like carbon output and sustainability things, stuff like that. So you can imagine these big oil companies are the ones that are saying, we're just going to enrich our shareholders, environment be damned. And again, I mean, no slights to the actual oil companies, just an example. On the other side of it, you can imagine that there's an alternative green energy sort of company that's saying, yeah, we're hoping to return some money to our shareholders as well. But we also want to make sure that, the other people in our community can continue to breathe clean air. That's all this document, or that's all this survey was essentially getting at is, do companies on average see other stakeholders beyond shareholders as an important third party between the firm and the shareholder and someone else? Do they see them as benefiting and an important consideration when determining what benefits the company can create? Do they see those external stakeholders as a beneficial party, as one that should really be considered when the firm takes actions? And so you can see in 2010, the majority of people seem to think that shareholders so it's a scale from 0 to 100. This part is essentially just saying stakeholders are the only ones that matter. This is saying shareholders are the only ones that matter. But these are the two interesting buckets. And so this is mostly shareholders matter. There's a little bit of other stakeholders in there. And in 2010, it looked like 45-ish% of the CFOs that were surveyed said that it's just shareholders only, or mostly shareholders. But now, in 2020, when CFOs are surveyed, they say it's about half and half. That who should benefit from the company's actions? How should the company be run for whose benefit? It's about half stockholders and half other stakeholders. And when they talk about who those stakeholders are, who are the other parties that should benefit from corporate activities? Up until this moment, we've just been talking about the value that a project might bring to the firm, right? The ability to repay our debt holders, the ability to repay our shareholders. But here, they're saying that the company should also be run for the benefit of the employees. And I think there's some value to that, especially to the extent that happy employees tend to be more productive. The benefit of customers. The fact that customers deserve not only a reasonable price or a positive engagement with the brand, but also to derive some value from whatever it is that the company's producing. The environment, that one's pretty obvious. It's nice to be able to breathe clean air. It's nice to not have to wade through trash to get to your job in the morning, and so on and so forth. I think putting creditors here is a little disingenuous because, okay, you're not calling them stockholders, but ultimately these are the people you owe money to. These are your capital providers. But I'm interested also kind of what none of the above was here. They don't go into too much detail in the Duke University survey here, but apparently there is a non-trivial, I guess it's about 18% of other stakeholders here that they didn't think were on this list. But suppliers, the government, local community, there are other considerations that are going on at a high financial management level within companies when talking about who should benefit from firms' choices. And so this diagram here was just kind of taking what we talked about before and establishing this idea of a financial market. So when we've got firms, these firms could be banks, so they could be capital providers in that way, or they could be actual operational firms. They could be making something or creating something. Those would be the capital users. And then we've got households, consumers, who are going to be capital providers to the extent that they can invest in new companies or invest in bonds, debt from a company. And they'll also be capital users to the extent that they might want to borrow money from a bank. right? An individual might buy a new car or buy a new house, and they'll do that using a debt instrument. They'll do it by borrowing money. Now, both households and firms, when again, firms include banks, will transact in this way through financial markets. And we'll go into this idea of a market in just a second, but the basic idea here is that firms can both provide capital and use capital, and households can do the same. And we use financial markets as a way to efficiently allocate that money coming from those two different sources in a way that hopefully increases everybody's welfare. That's kind of the basic concept of a market, is that it allows us to resource allocate. It allows us to take all of the money and all of the needs, put them in a big pot, stir it up, and hope that at the end, most people's needs are met in a way that everybody is at least a little better off. You may have heard that as described as Pareto optimal. Not super important for our purposes, but if you have ever seen that, that's kind of the idea of a market, that you want everybody to at least be no worse off. Now, the problems that a financial market are intended to solve is that both firms and households want to move their cash across time. For firms, they might have projects that are happening 2, 3, 4 years from now, but they need to take their money that they have sitting in the bank and put it to a productive use before those new investments are available. So maybe they have 2 or 3 months, not even years, 2 or 3 months where that money shouldn't just sit idle. It shouldn't do nothing. So they want to invest it in some way that allows them to keep it productive, helps fight inflation, and avoids this opportunity cost of just sitting dormant. Households also want to move cash across time. Retirement savings. That's the traditional example for households wanting to move money across time. To the extent that you're saving up money while you've been working in your life, and you're putting that, squirreling it away so that in the future, you can use that money to survive once you're past working age, you're wanting to move your cash that you have now into the future. And doing so is not costless. There are kind of these extra complexities that go along with making sure that the money you invest today is not only worth exactly the same amount, but keeps up with things like inflation and ideally grows. And this idea that you want your money to grow involves having someone else put it to a good productive use if you don't have anything to do with it in the meantime. So we use a financial market like the stock market or the bond market, pension funds, mutual funds, all of those sorts of things look like retirement vehicles. And households will take that money, their retirement savings. That's how they're capital providers in that role. And they'll take that capital, invest it into the capital user firms, into the firms that need that money to put it to a productive use that the individuals don't have the opportunity for. It's not, you and I can't just start a new project out of nowhere and make a 10% return. It's much more likely that someone who's an established player in an industry can do that. Now, the problem is neither of these parties like risk. Individuals are highly risk averse, and there's a long academic and professional literature on risk aversion. And essentially what it says is that if people don't like risk, the best thing to do is not to invest. But the problem is that doesn't consider this idea that not investing is itself a risk. It's just a future risk. It's the risk that at retirement, you won't have enough money to survive. And so you have to balance these two. The presence of current risk, this idea that I might invest my money and it might just be worthless tomorrow, and the idea that in the future, if I do not invest, then my potential payout might be too small for me to survive on. And so this risk concept is very, very helpful in the context of a market, because to the extent that households, individuals have different risk preferences, and the idea that different firms have different risk profiles, so high-tech startups versus well-established financial institutions. The different kind of heterogeneity in the risk available through the firm profile and the heterogeneity in risk appetite of households is well suited to a market because we can effectively allocate the various risky projects to the various risk appetites from those capital providers that are out there. You see the same thing when we think about the households as the capital user. For example, 2006, 2007, subprime mortgages were a pretty popular instrument. And effectively what that was there were some institutions out there who don't like risk, and there were some really high risk potential capital users, people who wanted to buy houses but didn't have the income for them. And the financial institution said, how do we create a way of giving these people the capital they need and package it in such a way that the risk is lower than each individual would otherwise be? Now, we all know how that ended, but the basic idea of financial engineering in that manner is the core idea of a financial market. This idea that if you package various risks together, whether they be in a pension fund or a mutual fund or mortgage-backed securities, in whatever way you package these things together, we can decrease the overall risk using this relationship between firms and individual households. So the way we're going to run this course, and the kind of the structure that I hope that'll work well for everyone, is that first we need to talk about this trade-off across time. This idea of how do you value this intertemporal difference, this difference between a cash flow today and a cash flow tomorrow. And then also, how do you make decisions about which cash flow is superior when you're faced with two alternatives? We're kind of leaving risk off the table for a moment. We will come back to risk, but for now, just assume the interest rate is a good stand-in. The interest rate tells us, or the required rate of return that we're going to use, is a good stand-in for the assessment of risk, whether it's from a bank or a financial institution. Whoever it is that's coming up with this interest rate, they have already done whatever the risk assessment is, and this is the correct assessment of risk. So we'll talk a little bit about that with NPV and with the internal rate of return. And then we'll talk about borrowing. We'll talk about borrowing as a way to affirmatively move your money across time. Now, when we say borrowing here, you can be on either side of the transaction. If you as an individual go out and buy a corporate bond, you've become a lender. You've taken your money and you've loaned it to a company who at some point in the future will pay you back. And it's important that we can value these cash flows across time so you know, or you can determine, what the correct value of those future cash flows is based on your individual risk appetite. Now, the market will set the interest rate for the firm. For example, AT&T. Say you wanted to buy a bond of AT&T, and you think the correct sort of risk profile for them is 7%. But the bond market's only out there with 4%. They think AT&T is more trustworthy than you are. They think AT&T will definitely pay you back your money, and they'll pay it at 4%, and that's it. That's the market price. Then of course you won't invest in that bond because you demand 7% based on your perception of their risk, so you wouldn't be a good match. You wouldn't go into the financial market that we've talked about here, and you wouldn't give them your capital. Instead, you'll look for an alternative source. So that's something we need to consider when we talk about borrowing. And then on the other side, we need to think about, as the borrower, how do we value the amount of loan funds we should take relative to the projects that are available to us? And also, what is an adequate cost of borrowing? Because we may believe, say we are AT&T now, we may believe that in reality we're stable enough to only pay 3%. The market's telling us it's 4%, and some people are saying as high as 7%. But to the extent that that's the market price for our risk profile, according to the market, we can either provide additional information that hopefully brings that interest rate down, although that's tricky to do, or we just have to accept that the market perception of risk is higher than we would like. So we'll talk quite a bit about how to do this trade-off across time. When we talk about the trade-off across time, it's mostly about moving cash flows across time. We're going to kind of leave the discussion for risk and risk appetite and all that sort of stuff to the second part. And when we kind of come back to this risk return thing, I'll do a little bit of a preview of kind of how that's going to go. But to do that, and as you guys learned on Tuesday, we do need a little bit of machinery. We need a little bit of kind of quantitative analysis techniques that we can use to apply to these problems. And so we're going to do time value of money today. We'll do we'll do a little more time value of money next time. We'll do some capital budgeting methods, things like net present value, internal rate of return. We'll do interest rates. And then we'll kind of come back. This is the moving things across time part, and this is the risk return part. And then we also need a little bit of institutional knowledge, because as much as these are just calculations, we need some kind of context to apply them to. We need to see how these calculations actually map into the real world, and we need a little bit of what people call institutional knowledge, essentially the context and kind of the flavor of the actual environment, so that we can speak intelligently about these decisions. So this picture, and again, having it open here on my iPad is causing things to kind of mess up on the formatting, so I apologize for that. But the basic idea of this course is then this. Again, we've got our firms over here who have their own internal sort of considerations for investment. And then we've got this sort of financial markets. We've got these capital providers over here. And these capital providers are going to provide capital to firms, either as investors in equity context or as lenders in a debt context. And kind of our course is going to be focused on how to make these financial decisions, either as consumers, as investors, or as corporate managers when we're considering sort of internal decision making. And so this picture is essentially breaking the class into those same two parts, these trade-offs across time and these risk return things. But the ultimate consequence of both of these, when we kind of mix them together, is that it'll allow us, these two techniques when combined, will allow us to value assets today. And when we say assets, it's pretty much anything. It's individual investment opportunities. It's a stock in a company. It's the value of a car. All of these sorts of things can be valued using the two methodologies we'll learn in the class. And these values, once we've been able to assess them, will allow us to make decisions. Because once we have some hard numbers we can put to a problem, we can say this one is clearly superior to this other one, given the assumptions that we've used in our modeling. So these values are going to help us make decisions by giving us a quantitative way to analyze some qualitative information. And so here's how I kind of think about asset values. Asset values, big picture, the value of anything, and I'll stand behind this statement. It's a big statement, but I'll stand behind it. The value of anything can be represented as the present value of the future cash flows of that thing at some rate of interest that we've determined that represents the risk. And so in order to determine those two pieces, we need both that relevant rate and we need the relevant cash flows. So if there's an asset that's just going to pay us one time in the future, that's a really easy one to value. If there's an asset that's going to pay us every year, slightly more complicated, but nothing we can't handle, the type of that cash flow sequence is going to be really relevant. How often those cash flows occur, the periodicity, whether they're annual or semi-annual or monthly, the term of that cash flow, how long will that periodicity last? Will it pay us 2 years or 3 years? And then the risk of those cash flows. Essentially, what are the number of those cash flows? Is it $100 or is it $1,000? Now, the risk here is independent of the risk assessment of the firm. It's more about what is the number of the cash flow, what is the actual value, not how likely is that value to occur. In the second part here, what is the relevant discount rate? Well, the relevant discount rate is that risk assessment that we've talked about. And so we'll start with kind of the current prevailing interest rate, the rate for just about any security. And then we need to match the term of that rate to the term of the cash flows. So we need to take these interest rates that are, say, the rate on a 10-year corporate bond and match it to a 3-year investment. Then, if we think our investment that we're considering is riskier or less risky than whatever corporate bond we've used to invest, or rather used as a benchmark, then we need to add a risk premium on top of that corporate investment, that corporate bond that we've now adjusted into our term of our investment. We need to add a risk premium or subtract off a risk discount to adjust the risk of the rate that we've been using to the risk of the investment that we're considering. Then, once we've done that, we need to do one final adjustment to the interest rate there to adjust to match the periodicity of the cash flows. So if we're thinking about a corporate bond that, say, pays semi-annually, and this project will pay us cash flows every month, that's an important distinction to make. And so we will need to adjust the discount rate effectively for that. And so I have a few examples here. Mortgages, other consumer loans, the loan balance, the balance of the loan, or you can think of that as the principal when we originally loaned the funds, that principal is going to be equal to the present value of the future loan payments. The balance on the loan will just be all of the future expected payments discounted back to today. So the cash flows of a mortgage are going to be those future loan payments, and then the discount rate will be the interest rate on the loan. Now, as I said, anytime I give you guys an interest rate, it's always going to be an annual rate. Now, that doesn't mean it stays an annual rate, but anytime I give you an interest rate, it will be annual unless it says otherwise. So you will need to adjust those interest rates, and we'll talk about how you do that, so that you can match the frequency of the loan payments that are related to it. Now, on the cash flow side here, it's pretty straightforward. The sequence is, if you've ever paid a loan, it's the same payment over and over again for the life of the loan. Now, obviously, with like credit card debt, the payment varies, but think more like a fixed loan, a car loan or a mortgage, where it's the same payment every month for however long the duration of the loan is. And then the periodicity for most loans tends to be monthly. Now, that's not a sure thing. Plenty of loans have abnormal terms. Some require, say, biweekly payments if it's like a payday loan or something like that. But generally speaking, we can think of them as monthly. On the stock side. So on the stock side, the price of a stock, again, what we're doing here is we're determining the value. We're determining the value of an asset today. The value of this loan is the present value of the future loan payments. The price of a stock, the value of the stock, is the present value of the future cash flow that that stock will produce. And so the cash flows that we need to consider are going to be the future dividends. Again, we'll come back to share repurchases. Effectively, a dividend and a share repurchase are exactly the same thing from an investor's perspective, but we do have to kind of distinguish them because they are separate transactions. But the future dividends of the firm, well, the problem is we don't really know how often these cash flows might occur. Maybe a company only pays a dividend annually. Maybe they pay it quarterly. Is it always the same value? Maybe or maybe not. Does it typically grow by a certain percentage every year? Does it typically grow by a certain dollar value every year? These are considerations we need to take into account. And so we'll have some methodology. I'm going to skip talking about the math for now, but we'll have some methodology, and it's really just this formula. It's not that complicated. We'll have some formula, we'll have some methodology that we can use to make this problem a little simpler. Now, that cash flow is a future dividend, and the risk of that cash flow then will be the risk of the sort of internal mechanism that's going to generate the cash flows, the risk of that company. And so the risk of that company, as we'll learn eventually, can be diversified away, but for the market risk. So essentially, if I invest in Tesla, that has all sorts of unique risks of just being Tesla. But if I invest in Tesla and Ford, now I have, well, I can kind of net out. If Tesla doesn't do too well, that's probably good for Ford. And so Ford will go up when Tesla goes down and vice versa. But if all car stocks go poorly, because say public transportation becomes more popular, now I have a problem. It's not just the market risk, it's also the industry risk. So maybe I invest in some municipal bonds that will pay a higher rate of return, or rather, I guess that's not strictly true. Municipal bonds that will be worth more when the city's resources are used more frequently, when people are paying more for public transportation. The liquidity of those bonds will go up, the surety that they will pay us back goes up. So those bonds become worth more when the future payments become more certain. And so we can kind of invest in those as a way of offsetting the potential risk that the car industry goes down. And so over time, as we start to do this diversification exercise, when we start to diversify our risk into various pools, then all that ends up being left is the risk that the overall market goes down. Macroeconomic sort of risks, risks that we can't diversify away because every company is exposed to them. And so the specific structure of this model isn't important. It will be when we come back to it. But for now, it's not super important that you understand the functional form here. Just this idea that the risk inherent in the firm's activities will determine the discount rate, but only to the extent that the average investor can't get away from that risk. If there's something unique to Tesla, it doesn't make sense to price that into Tesla's stock price because you could very easily protect yourself from that risk by investing in something else as well. We'll talk about this a little bit more when we come back to the idea of a market price. Now, you'll notice here it's described as the cost of capital. The cost of capital is just the other side of saying an interest rate. So for example, if you go to a mortgage broker and you get a mortgage, you buy a house, you pay, say, 4% on that mortgage. That is your cost of capital. That is the cost that you're incurring to borrow that money from the bank, right? Well, from the bank's perspective, that's the return on their investment of that capital. So now the two sides of that relationship, one side views it as the return, the value, the benefit that they get from loaning that money. The other views it as the cost of borrowing that money in the first place. So the cost of capital here is from the company's perspective, from the borrowers, the investees' perspective. The kind of return component will be viewed from the investor's perspective. But ultimately, they're two sides of the same coin. They always end up being the same number. We've talked about this already, but the idea that corporate investment projects look very similar to this idea of a stock or a loan. A corporate investment project is effectively just a series of cash flows. And to the extent that we want to value that project and tell ourselves, yes, this is a good project or it's a bad one, we should do this one or this other one, we need to be able to determine a current value or some uniform value of all of the potential cash flows of all of the alternative projects. So we'll say the value of that project, this stands for net present value, but that's not super important for now. The net present value, or the value of the project, the price we could assign to this project, is equal to the present value of all of the future cash flows, call them free cash flows, but we'll come back and define that better later. The present value of all of the future cash flows this investment could throw off. And so these cash flows we're going to call incremental free cash flows. They're essentially all of the after cost flows from the project. So you can see the revenue is the amount we take in, subtract off the costs, both fixed and variable, subtract off depreciation, apply a tax rate. You'll notice we add depreciation back because depreciation is not a cash flow, it's a decrease in value. We subtract it off here so that we can get the tax effect. Subtract off any capital expenditures and subtract off any net working capital, which again, we'll come back and talk about that a bit later. But the basic idea is that there will be some cash flows thrown off by these investment projects, and that we need a systematic way to value those cash flows. Now, the cash flow sequence is ultimately going to be determined by really whatever the cash flows of the project are. Typically, the way we deal with it is as a sequence of single cash flows in each year. They need not be the same number every year. In fact, it wouldn't make much sense if they were. They don't even need to grow by a consistent rate. But there's some sequence of cash flows that we can think of as kind of the annual cash flow from the project. There's usually an upstart cost and a terminal value as well. Now, I don't have the upstart cost here, but there's usually a startup cost to any project. You have to buy the machinery or whatever. And at the end, you can usually dispose of whatever that startup investment was, and you can recapture some of that cost. So all of those things are going to go into our cash flow determination. The discount rate perspective takes a slightly different view here. So here, when we think of the discount rate, we think of the weighted average cost of capital. And we will come back to this idea, so it's not important that you understand it super well right now. But the basic idea is that any company will be funded partially by equity and partially by debt. So partially by borrowing money and partially by soliciting investors. And so this weighted average cost of capital will be both the cost of equity, that's what RE is. If you look back here, RE here was the cost of equity. And RD, which is the cost of debt, ignore the tax for just a second. These are the weights. It's the amount of equity that you have, say $100 of equity, over the equity plus the debt. Say you have that same $100 of equity plus $150 worth of debt. Now you can determine the percentage of your capital structure that's determined by equity. Essentially, say it's 34, or in this case, it would be 1.5 times your debt. So you have 150% of whatever your debt capital is as equity capital. A lot of firms, it's easy to kind of just take a quick look and say they've got 40% of their money coming from debt and 60% coming from equity, or so on and so forth. Here it'd be more like 33 and 66. But the basic idea is that once you know the proportion of their capital structure that's determined by equity and the proportion that's captured by debt, multiply them by the relevant cost, and you have the weighted average of the capital that they borrow or that they receive. And to the extent that you have this weighted average, it's essentially just assuming that the money you invest in these various projects comes evenly from all of the various sources of capital that you have. Now, of course, if you take out a specific loan to fund a specific project, it doesn't make a lot of sense to use this weighted average. But we can actually argue that it does, and we will develop that argument a little bit formally later. Last piece here, there is a tax benefit from debt because you can deduct the interest. And so that's what this other thing is saying here. So the cost of debt, whatever, say the 4% on your mortgage, doesn't consider the fact that you can then deduct your mortgage interest on your taxes and save up to, say, 35% of that interest in tax savings. So that's what this kind of tax rate thing is doing. And then finally, a firm is nothing more than the composite of all of the projects within the firm. And I think that's a reasonable argument to make, because if you imagine, say, your household finances, say you and your spouse both work, the value of your annual income is just the sum of each of the individual incomes. So for firms, the enterprise value is just going to be the present value of all of the free cash flows, but from all of the potential investment projects of the firm. We use the same weighted average cost of capital here. This one makes a little more sense because here we're dealing with the free cash flows from the entire company. And so all of the capital that's ever been borrowed, or all that's ever been invested by equity investors, all of that cost has funded all of the potential projects that are out there. And so it makes sense to figure out what our blended sort of average cost across all of the various capital sources is when we're valuing the firm. Okay, so last piece here, this is where some of the other finance courses fit in. So on the left here, we've got our firms again. On the right, we've got our kind of capital markets. Advanced Corporate Finance 1 will deal with real investments. Advanced Corporate Finance 2 will deal more with capital structure. Investment theory kind of is this whole big box. It'll mostly be about capital markets, but a little bit about financial intermediaries. Fixed income will deal with the debt piece. Private equity will deal with the equity capital. Venture capital will also deal with this equity capital. Mergers and acquisitions of firms comes in Advanced Corporate Finance 3. Financial intermediation talks about banks, insurance companies, pension funds, all that sort of stuff. Derivative securities will be down here in the capital markets piece. So to the extent that you find a particular part of this course more or less interesting than the others, this is a decent map as to where you should spend your future course allocations.